What is up, everyone? Welcome back to the Fresh Finance Podcast. My name is Thomas Elms. I've got my co-host here, Kyle Ryan, and today we wanted to put together a video to honestly just kind of recap what the heck happened in 2022 market-wise. There's just so many things that event-wise drove the market that we just had no idea was on the horizon. We also had some things that we think, kind of hindsight is 2020, we probably could have predicted, but that's just the glory of what we do. But we also just kind of wanted to welcome everyone back. We've been on a bit of a hiatus. Kyle and I had just a little bit of a compliance issue, with the podcast, us being at different broker dealers, but we're super excited to get started again now that Kyle is officially at LPL. Kyle, are you liking the transition so far?
Everything is nice and steady, and haven't run into any major issues yet. So just happy to be here and happy to be back on the podcast.
Perfect. I love it. So today, like I said, we're going to be recapping what the heck happened last year. And I think it's honestly a really fitting time for us to kind of get back into the podcast, start doing episodes again, because I think that there was just so much that happened, so much that we can talk about, so much that we can educate about for people that are still just kind of on the fence or have, rang in the new year and they're like, geez, like this last year has flown by. What on earth can we make of this? And then what can we kind of look forward to next year? And I know that we talked offline here as we kind of gathered our information for this podcast episode. And we kind of just wanted to unpack everything from a somewhat chronological order here and just kind of starting in that first quarter of 2022 and honestly kind of like the last quarter of 2021. We just started this year off with this crazy supply chain issue situation, which is still a little bit of a factor today, but it wasn't anything like what we saw fourth quarter of 21 and then that first quarter of last year. And I think it was kind of the bane or the beginning of what really happened last year, and then it kind of progressed into the Russia-Ukraine situation, which I think a lot of people in the United States at the beginning really overlooked the importance of this. And I know that you and I have talked about this before, but when you look at Russia and Ukraine from an economic perspective, right? So Ukraine their GDP is about the size of Louisiana's, but they're the number one exporter of grain in the world. And so you think about kind of the targeted effectiveness or the targeted impact that Ukraine being in this militant state, what that kind of caused on the economy. And then you look at Russia, their GDP is about the size of Texas's, but when you look at their targeted approach to the economy, they're one of the largest producers of oil and natural gas. And so we kind of saw those two sectors get hit. And what did that kind of overlook is inflation. I'd love to just kind of get your take on where inflation kind of came out of the woodworks and then really just kind of became the forefront of where we're at today.
Yeah, I mean, I think you hit it on the head. Inflation is what caused 2022 to be the year it was, one for the history books, and hopefully something that, as with all history, it just stays as history. You don't have to relive it, right? Because that was terrible. What the name of the game really was for 2022 was inflation, and what really caused it was the supply chain issues, and really it all stemmed back from COVID. I mean, if you take it from a big picture perspective, it makes all the sense in the world, right? Mm-hmm. You have an economy that's going really well. 2019 economy was strong. Early 2020 economy was strong. And out of nowhere, we get hit with a once in a century pandemic, shuts everything down. No one knows what's happening. The issue was people were still flush for cash. I mean, if you remember back in 2020, we were buying things like we had something to do with it. If I couldn't,
savings rates were at 40-year highs, 40-year highs of savings rates. And they went down to traditional norms in 9 months.
Yep. Very quickly. And how quickly we went through an economic cycle is just baffling. But, people had all this money and nothing to do with it. And supply and demand, inflation 101 is having too little of something and having demand far too high, right? You're going to increase the price of it because people are willing to pay more. Well, people have all this cash, nothing to spend it on. All right, that's fine. Now the economy starts opening up late 2020. We run into the supply chain issue because we weren't producing. No factories were open to create goods. We wanted a lot of goods because we had nothing better to spend our money on. We weren't going out and, going out to service economy, spending it at restaurants. We were buying goods, buying wood for my backyard, to build the deck, right? So all this money's being spent. we can't keep up with it from a supply perspective. We can't produce enough. So all of a sudden, inflation starts catching up. Inflation starts going rampant. So what do you have to do? You have to start paying your employees more. So wage growth goes up. Now you have wage growth and inflation going up, and they are like a cyclone. They're just going to continue spiraling upward until someone puts a stop to it, which essentially is the Fed rising interest rates, right? We've talked about this last year when we were doing a bunch of episodes on it. And, you know, the name of the game with inflation really is it got exacerbated because of supply chain issues, which came from the pandemic. And how do you fix it? You got to raise interest rates and crush demand. And that's really been the story of this year from the Federal Reserve's perspective. They need to crush demand to handle inflation.
Yeah, absolutely. You know, and I'd be remiss to not include kind of this idea of the stimulus, the COVID stimulus that came into play. You know, no matter what side of the political spectrum that you're on, when you input $5 trillion worth of cash in anywhere from 12 to 24 months into a system, especially like the United States, that's going to affect the value of the dollar. It's going to infect the pricing of certain goods or services, whether they're coming in or going out of the U.S. economy. And, you know, kind of re-hitting on this interest rate conversation, what the Fed was trying to do is at the beginning of the year, everybody was saying the word transitory. It wasn't going to be a long-term factor. Well, I think all of us can, you know, admittedly say that anybody that did have that perspective was incorrect, because it was here to stay for at least 2022. And, you know, we've seen a lot of consensus outlook on the fact that it's probably going to be here to stay for a little bit longer than we expected. You know, that'll be a conversation on the rate hikes that we touch on here later. But I think one of the biggest things from a stock market perspective or from an investing perspective that inflation played was the government was forced to hike rates faster in history than they ever have before. And when you raise interest rates, you hurt the bond market. And, you know, as we've talked about, 2022 was the worst year for the bond market since the aggregate bond index has been a thing. You know, so if we kind of throw in some of these other elements with the bond, you know, portion of things, I think it was really kind of a tragic year because so many people were nearing retirement, or maybe they were considering retirement during COVID, and they were in kind of that traditional 60-40, you know, 60% stocks, 40% bond portfolio. And for the last 20 years, bonds have been a very conservative place to put your money. And these, you know, drastically hiked interest rates destroyed the bond market, and, you know, people felt a lot of pain. And, you know, I think that was one of the most emotional pieces to this year as well, is the pain was so unexpected because the bond market has been such a backbone for, you know, consistent, stable places to put portions of your portfolio, and that no longer is the case. You know, and so I think that was a key thing as well. The other thing that, you know, we kind of saw, I would say mid to end of the third quarter and then all the way through the fourth quarter, is this looming idea of a recession, and also just some of these large companies starting to, you know, start to lay off employees or roll back hiring, things of that nature. And I think that really plays a role in kind of the emotional impact, or the, you know, the social perspective on the market, because people start seeing, you know, these interest rate hikes start to affect the corporations that they purchase from. You know, I think that definitely plays a role as well.
Yeah, and one other comment I wanted to make about the 60-40. A lot of people don't realize in 2022, the 60-40, the balanced portfolio, supposed to get growth and income, did worse than it did in 2008. You know, so people think of the historically worst times in the stock market. Now, the stock market did not do as bad as it did in 2008, but a balanced portfolio did, because we have never seen, not for a very long time, a runoff in bonds like that. I've had a lot of clients ask me, why did the bond market do so much worse this year than it ever did in something like the 80s, you know, late 70s, when the interest rates were rising, right? Because you think of the value of a bond is directly impacted by interest rates and how much it yields, right? So when interest rates in the 80s went all the way up to 15%, you have 15% mortgage rates. I think 7's high now, 15%, that was high. So you'd think, why, when interest rates went up so quickly in the 80s, you know, you had Volcker, the recession killer, you know, why didn't the bond market do so poorly then, right? It's because the bond market went from having a yield of around, you know, 8% to 16, 15%. It doubled. That's really negative, you know, that harms the bond market. Well, we only went from zero, pretty much 0.25 to roughly, it's a little under 4 now. That is like a 16x multiple on the interest rates on bonds. That's going to absolutely destroy your
Yep.
performance of the net asset value of bonds. It's only 4%, but it's going from 0 to 4%. That's the big difference, and a lot of people don't realize it.
Yeah. Yeah, absolutely. And I think that this, when I look at it as an advisor, but also as an investor, this year was kind of a wake up call year, and the fact that the 2010s were probably, based off of the numbers that we've seen, probably one of the best stock market 10-year rallies that we've ever seen as far as cumulative return in that time frame. 2010, post crisis in 08, 09, 2010 to 2020, before COVID happened. Well, and even after, we had a sharp recovery, the 2010s were probably one of the best years in market history. And people just had this euphoria that, irregardless of COVID, especially with the sharp V recovery that we had, after we lost 10,000 Dow points in March, they thought that we were just out of it and we were good and we were just going to keep steaming ahead. And I think that kind of presses on this idea that, we look at, November and December of last year, and all of these major stock market technicians that, are the talking heads on CNBC, they're talking heads all over the place, are giving their outlooks for where they expected us to be in December of this past year. And the consensus estimate was like 4,900 on the S&P. We're chilling out at 3,800 right now. So we're about 1,000 points off. And it just kind of goes to show that it's always nice to take into the consideration what some of these technicians are looking at or thinking about, because they do take a very rigorous approach to how they're evaluating and putting together these market theses. But at the same time, the market does not care about their outlooks, right? And economic events, geopolitical events, they don't care about what JP Morgan's outlook looks like. And that is not a dig to JP Morgan, because they put out really great relevant information, but it just doesn't care. And so trying to be agnostic and unemotional when you're investing, and having a plan that you can bear in relation to your goals, I think that was just kind of a big learning lesson, personally for myself in both capacities.
Yeah, and I think we really have to gear up, as investors in the 21st century to prepare for that. I mean, in this century alone, we've seen plenty of once in a generation events. No one saw
Yep.
9/11 happening. No one saw COVID happening. And it's just in the past 4 years, right? We didn't see COVID happening. We didn't see Russia invading Ukraine. The Chinese shut down, the zero COVID policies had a real impact on the global economy. Now they're reopening. What's that going to, there's a lot of things that have come about over time that you couldn't predict. And even when it's happening, you can't foresee how it will impact us. Look at the 2020 pandemic, right? One thing that I think we want to talk about that's really, really important is the disconnect between the market and the economy. Mm-hmm. From both ends, right? So what they always say is the stock market is typically 6 to 12 months ahead of the economy. What do they mean by that?
Forward looking. Yeah,
it's forward looking. So what do they mean by that? That means that in March of 2020 and February of 2020, when the world was beginning to find out what COVID was, and the market had one of its fastest sell-offs in history, 35% in 5 weeks, that's because the market doesn't like one thing more than anything else: uncertainty. We had no idea what was coming. We had no idea what was going on. But the bottom was set in the market when certainty came. When March 23rd, when Jerome Powell and the Federal Reserve and the government, they all stepped in. They were going to do all of the stimulus, the PPP, the unemployment. As soon as that was announced, that meant that the government, we weren't getting left behind. The economy wasn't collapsed. That was the last the market saw of the bottom. We recovered faster than we have in years once we had certainty. But in June, we still had no idea what was going on. We were still fully in COVID. It was only getting worse, but the market was getting better because it was forward looking. Now, what's the opposite end of that? The opposite end of that's 2022. The economy, even today, is still on really good footing, whether a lot of people believe it or not. What sells the most news? Bad news. So they're not going to focus on the economy doing well, but the economy is doing well this year. Market did terrible this year because the expectations are next year we're going to have a slower growth economy, and the market's already priced that fully in, right? So when you hear something, Good.
No, I was just going to say, understanding that if you're in January of 2023, like we are today, understanding that the stock market itself is priced in at least at the earliest June of this year or right around this time next year.
Yeah. Yeah. And we, the two of us, we're not in the business of making analyst projections and
Yeah.
forecasting but what we can reasonably see coming down the pike is based on what's been told to us is Fed's going to continue raising interest rates, maybe another 75 bips, 0.75%. From here to March, whenever they get that done, the expectations are it's going to start coming down from there. And once, and everything the last 13, 14 months has been don't fight the Fed. Don't fight the Fed. When they're raising interest rates, be protective. When they're cutting it, maybe take a little bit more risk in the portfolio. But that's really been, the name of the game is just keeping tabs on what the Fed's looking at, namely inflation. And that's really what moved the market last year.
Yeah. Yeah. What do you have to say about this year? What are you looking at this year? Kind of what are your general thoughts? And we don't want to go and be hypocritical here and give market outlooks.
Yep.
But general thoughts that you're having about 2023 and kind of how we see kind of some of this stuff unwinding. I know that you just kind of mentioned the interest rate conversation. We think we're going to have 25 basis point hikes here over the next 3 months, and then cool down. Hopefully we start to see inflation really starting to take that regression back to the norm. But what are some of the things that you're thinking about right now?
Yeah, from a purely factual perspective, they have a lot of people who track the yield curve inversion. So a lot
Yep.
of people, the popular one's the 2 and the 10-year. That's very popular. The most accurate one is actually the 3-month and the 10-year. If those ever invert by more than 25 basis points and stay that way for a given amount of time, there is 100% likelihood of a recession based on historical performance. So chances are, based on that, we're going to go into a recession. In my opinion, it's not a matter of if, but when. It's just the real question is how deep of one are we going to go into? Are we going to fall off a cliff? Or are we going to kind of wade our way into some swampy waters, right? So we don't know what that's going to be. Like I mentioned before, when you go into a recession, what drives the stock market? Stock market fundamentals. What are the companies doing? Are they growing? Are their earnings growing? Are their dividends growing? Well, earnings typically, if we go into a recession, they typically decline anywhere from 10, 15%. So if you see an earnings decline, that could have a negative impact on the stock market. But let's not forget, and let's not take away the power of the consumer, right? Because consumers drive the market, algorithms drive the market, consumers drive the market, right? And consumer confidence is at an all-time low, lower than it was in 2008, which is baffling. Why? Because what controls consumer confidence? It's when you're driving and you see the gas prices and they're really high, that lowers your confidence. When you are taking money and putting it on a credit card to live, that lowers your confidence. That's what we're seeing a lot of this year. And typically what happens after you have super low consumer confidence is you have a spike. People are usually wrong when they're the most confident. That's when the market's at its top, and the least confident is when it's at their bottom. So historically, people would say we're going to go into a good year because we had such a bad one. People's expectations should rise. But, just like we mentioned, you never know what's going to come down the pike. What's going to happen with China? Are they going to reopen? Is Russia going to agree to a ceasefire? Is it going to get worse? So it's really hard to predict anything. It's just, I would continue really monitoring the risk in portfolios and, all depending on your time horizon. If you are getting ready to retire and need your money, I would continue to stay very conservative.
Yeah, absolutely. And I think that I just want to hit on, what you're talking about is kind of the impossibility of prediction, right? And making sure that you're making a point to yourself as an investor, if you're doing this yourself or if you're working with an advisor, that you need to try and disconnect your short-term personal feelings with how you're allocating money to your portfolio. And that can be stocks to bonds, that can be whatever, but making sure that you understand the timeline of how you're investing, right? Because if you have a 30+ year time horizon, this is going to be a small blip on the radar for you. But if you're kind of approaching that retirement age, or if you're in that retirement age, that's a conversation that you should have been having before we ran into this catalyst, right? And understanding, the positioning of how you're doing things. I think that's also why it's important to, be working with a financial planner is, having somebody that can kind of stay on course and on track with that with you, because there's so many people that I run into where life has happened and they haven't checked their portfolio in 2, 3, 4, 5 years. they haven't adjusted allocations. They haven't, and they haven't done that in relation to their financial plan, right? And so, I think that's another big thing is disconnecting your feelings from your investment strategy, and tying that investment strategy to when you actually need that money. And it's going to make your life a lot easier, and I think too, this is also a return that is priced in with the past returns. And if you look at the 15-year number on the S&P, it's still hovering right around that 9, 8, 9, 10%. So understanding that there are going to be these types of years that are in a way kind of unavoidable, and sticking through those years, continuing to contribute to your accounts, and using this as an opportunity to buy stuff at a discount is super important.
I couldn't agree more. I've seen a lot of people in their 401ks, we get together and I'm like, hey, how'd you come about picking this? Oh, well, it did the best last year, so I did this, which could have
Yep.
left you with a lot of technology last year. So,
Yep.
don't reallocate your 401k to the best, performing one, because you're going to end up holding the bag. Usually what leads us into the bull market cycle does not lead us out of the bear market cycle, meaning tech did really well the last 10 years. Typically, the sector that leads us through the bull market is not going to be the one that leads us out of the bear market. So that's Jake.
I think that's a great point. So next video, we're going to break down the Secure Act 2.0 that just came into legislation here in the past few weeks. This is essentially a new legislation that has brought a lot of reform onto retirement plans, contributions, availabilities. So we're really excited about that. I hope that this video here helped today to kind of recap 2022, but also this next video, we're super excited because there's a ton of really great improvements that the government has passed into law that you can now take advantage of. And we're super excited to kind of break down those key points. So thanks so much for watching, and we can't wait to tune in here next week. Thanks so much.